All right, in terms of the investment outlook, here's what we see. Going back to 2013, I'll get you oriented to a chart that you'll see again. So 2.8% of last year's 32% return came from dividends and buybacks. 11.2% of last year's returns came from actual earnings growth in the companies within the S&P 500. So you add those two things together, I think it adds up to 14%. So the fundamental return on the underlying equities in the stock market was 14%. The remainder of the advance came from an expansion in multiples. Animal spirits, make things more expensive. So 18% came from multiple expansion. Add them up, it's 32%. All right, let's use that as a framework to think about 2014. So we are going to get our dividend yield, so we are going to get our 2%. That's easy money. What about the earnings? Well, if the globe is growing at 3% or so, 3.5%, jack it up a little bit for inflation, nominal GDP on the globe, 5% or so. Right now, Standard & Poor's forecasts that the S&P 500 will grow revenues at 4%. Profit margins are pretty darn high, but they expect that you can get a little bit more lift there. And so ultimately, they're projecting that earnings in the S&P 500 will grow 10% this year. Now, we think that's a little rosy, and so we'll discount that. So WNA's more conservative take is, I don't think profit margins can expand that much more, so maybe it's 8%. So we'll discount that by 20%. So the fundamental stack, right, for us to start thinking through our expectations for returns this year should deliver about 10%. Sounds good, right? Well, there's more. So let's talk about valuations. Stocks are still more attractive than bonds. So if you invert the PE on the stock market, you get the earnings yield, which means you can compare it to bonds. And the earnings yield on the stock market is 6.5% right now, and the equivalent bond yield is about 5.3%. So stocks still have an advantage over bonds. That's good news. But stocks relative to their history are actually expensive. So stocks are somewhat expensive relative to themselves. The long-term average PE rate, as you probably all know, is around 15, and we're trading at about 17 times trailing earnings today. So stocks are a little pricey relative to themselves. So now let's bake into our bar chart here the impact of valuations. You could see valuations go 5% higher, or you could see valuations slip by maybe 10%, therefore wiping out your fundamental stack. So my best guess is the range of returns is probably between 0 and 15%. If you want to split the difference, it's about 7.5%. So because of high valuations coming into this year, even with decent fundamentals, our expectations for the market are pretty minimal. But the good news is that the valuation problem in the U.S. does not match the valuations overseas. So this is kind of interesting. Right now, if you do a 10-year trailing earnings PE on the S&P in the U.S., we're trading at about 25 times earnings. Now, we spent a lot of time in here talking about the BRICS and the pigs. I'm not going to give you a quiz, but I'm sure you remember that the BRICS are Brazil, Russia, India, China, supposedly the engines of growth on the planet, so growth stocks. And the pigs are Portugal, Ireland, Italy, Greece, and Spain, kind of the value countries on the planet. So we're trading at twice the BRICS, and we're trading at 3 times the pigs. In fact, even though we were up 32% last year, I think Ireland beat us, or Portugal. I mean, the pigs actually, you wouldn't believe it, outperformed. But if you can buy something for 2 times earnings, it's not a bad idea. So anyway, you map those two things together, and the global picture is a little better. So as global investors, we're more encouraged. If you take the U.S. and you put the international stocks together, you'll see that overall the world is relatively inexpensive, which gives us plenty of shopping to do. All right, we have to talk about the taper. Obviously, the taper is the Fed removing its monetary stimulus at each of its meetings. Janet Yellen was back on the Hill today. I love Janet. The first time she spoke, the market went up 276 points. It closed at an all-time high today. Stacy, I don't mean any disrespect, but if she was available, All right, so in terms of, you're not allowed to talk, Carl. So in terms of the Fed, here's what we know, right? Because we're off on the edge of the cliff here anyway. We are basically in monetary policy territory we've never been in before, so let's just use charts to figure out where we go next. So when the Fed is engaged, it tends to be good in the market, right? So QE1, the market went up 42%, then they took a break, market trended sideways, then they got re-engaged, the market went up 9% or so, and then they took a break, and the market went down 11.25% or so. From there, they engaged in a whole lot more expansive monetary policy, and markets went through the roof. So the Boolean, conclusion you can make here is when Fed giveth, market, taketh. If Fed taketh away, then maybe that's not a good thing. So there's some concern that if the Fed retrenches from quantitative easing, that the markets will roll over.